showtime. How's everyone doing? You are in the strategy room with the banker next door, Dr. Joe Berquist, on this Saturday night, March 14th, 2026. I hope everybody is having a great night out there and hopefully a great weekend so far. So I'm a little dressed down tonight. I've got my little St. Joe's Hawks shirt on. As everybody can see, I was trying to show my team a little love as they were playing in the Atlantic 10 tournament. Unfortunately, I know that they already lost, so I was hoping they were going to make it to that A10 championship game, but it just was not meant to be this year. So, but still wanted to show them a little bit of love, regardless. But tonight. I've got a great show for everybody tonight. We are going to be talking a lot about private credit tonight. A lot of updates, a lot of craziness happening in the market this week. We're also going to be looking at a number of economic indicators that came out this week. We had some GDP, we had some CPI, and ultimately, what do these economic numbers mean for the Fed decision, the Fed interest rate decision, the Fed meeting? That is going to be coming up this week. Is the Fed going to continue to lower? Are they going to stand pat? What are they going to do? Now, I personally think they're going to stand pat, but like I said, we'll get into all that a little bit later. I've got a lot of banking news for everybody tonight. Also, we're going to talk about this housing bill. We're going to talk about this housing bill. Does it really ban big Wall Street firms from investing in residential houses? I don't really think it gets there, So, but we'll talk about that. Some proposed capital rule changes coming for banks. There was a thing called the Basel III capital rules proposal that's getting revised right now. So we're going to talk about that a little bit later. So we've got a lot of stuff on the horizon tonight. So, but let's get in as I always do. Let's jump into our debt clock here, and let's take a look at just some of the key numbers that I always like to look at. The national debt still at $38 trillion, but as you can see here, we are getting very close to $39 trillion. Will not be too much longer there, and that equates to a debt per citizen of $112,000 and a debt per taxpayer of $356,000. The U.S. federal spending is still a little over $7 trillion, with the U.S. federal budget deficit now is hovering around a little under, just a hair under $1.7 trillion, still to the negative. Now, interestingly enough, it does still have tariff revenue here of $376 billion. But as we know, there will be tariff revenue, or there will be tariff refunds going back to companies, probably somewhere in the neighborhood of 130 to 160 billion of that 376 billion will be going back in the form of refunds. Okay. However, at least as it stands right now, this stands to revenue per taxpayer of $3,247. Now, the interesting thing is that President Trump did state that he might try to give people a $2,000 refund check. And despite the fact that he would have to give the refunds, he may still well have enough money there to actually do that $2,000 check. I don't know if they're really going to do that. I mean, it hasn't been much talk about that in the last couple of months. I'm just pointing out the fact that it would still be a possibility. Maybe not quite 2,000, but who knows? Maybe they give $1,500, $1,600, something like that. We'll see. The debt to GDP is basically at 124%, still ridiculously too high, way, way, way too high. Interest on the national debt is still inching ever closer to that $1 trillion mark at $992 billion. And that is just the interest that we pay just to service the national debt. So like I said, always like to open up by just pointing out some of these numbers because it's a great show as to where we are. Gives us a great little roadmap as we go through a number of our conversations that we have here every single week. So, okay, I want to start off with you know what? Before I get to all the private credit news, there were a couple things that I wanted to run over real quick. So we still have this fight. We still have this kind of quasi government shutdown, and I just want to, because again, I don't want to get. I'm not going to get all into the politics of this. I just wanted to point it out that it is something that's out there. It's still kind of hanging over a lot of things right now. But Senate floor fight reveals how far apart Democrats and Republicans are on DHS shutdown. Both parties blocked each other's funding proposal over 2 days, exposing a wide gap on ICE reforms with no deal in sight. And obviously, this is having an impact on airports right now. Airport security. If anybody's been paying any attention to some of the news this week, airport security lines are 4 miles long right now at just about every airport. Not a fun time to be flying, that's for sure. So again, this is still out there. It's still hanging on, and we'll see what happens with that. Because of the Iran war, if you will, or conflict, however you want to describe it right now. Obviously, the price of oil shooting up was big news this week, and we'll get to that in just a minute when I go over some of the other numbers on interest rates and bonds and treasuries and things like that. But we got this news: 172 million barrels of oil to be released from the U.S. Strategic Petroleum Reserve. The move follows an earlier announcement by the International Energy Agency, whose member nations pledged to make 400 million barrels of oil available. Now, that really, the International Energy Agency, them releasing the 400 barrels, that is really to help Europe. Like that's mainly who that is going to go to help is Europe. The 172 million of that is our strategic U.S. Petroleum reserves. Now, I am not a fan of this. I really don't like this move. I really don't think we should do this. And now people would say, well, the price of oil is going up. Why wouldn't you do this? Well, first of all, President Biden basically, over the last couple of years of his administration, he had basically gutted the petroleum reserves. And so we really needed to replenish what had been, President Biden basically got rid of half of the petroleum reserves, and he really depleted it. And President Trump, over the last year, he started to put some oil back, but we have not gotten anywhere back to the levels that it should be. And President Trump, even though he was putting oil back last year, only got it back probably about a quarter of the way that that we needed to go. So so for that reason alone, like I think we should continue to keep building the reserves back to get them back to where they need to be. This is certainly not going to help. I mean, you take 172 million barrels out of the reserve, you're going to put us in a hole that it could take. And then a lot depends on, well, what does the next president do? Does the next president, put the oil back in here or not? Who knows? I just don't like this. And then, but the bigger issue I have with it is that this has happened multiple times before, where a president dipped into the petroleum reserves for either political reasons, I hate to say it, or because there was economic things going on and they were trying to just help to ease the situation. The problem is that it has never really worked. It's never really worked. It's never really had any kind of a sustained or massive impact on the price of oil or bringing the price of gas down. And so I guess because of those two reasons, because of the fact that this never really works the way that they think it will, and number two, our oil reserves are already massively depleted. I just don't like this. I don't like this move. I don't like this strategy. And I think it's kind of too soon. I think it's kind of too soon. Like, nothing. Everything in Iran, whether you like it or don't like it, everything so far has, in a certain respect, has kind of gone according to plan. We've wiped out their Navy. We've wiped out their Air Force. We've shut down all communications in the country. We took out the supreme leader. Other than the unfortunate few casualties, everything has gone so far the way that they were hoping it was going to go. Now, I think they were probably hoping it was going to be over already. That's not there. But again, yes, we have seen the price of oil spike up, but is it like at a panic moment? No, I don't think we're at like a concern moment, a moment of high concern. We're not in a moment of panic. So I think it was a little, like I said, I think this was a little too quick to do this. So, but anyway, we'll like I said, we'll continue that conversation in just a second. And then Trump says U.S. will build first refinery in 50 years with investment from India's Reliance Industries. So Trump announced a $300 billion refinery project backed by Reliance Industries. The plant was planned for Brownsville, Texas, processing U.S. shale oil. Trump said it would be the first new U.S. refinery in 50 years. So President Donald Trump announced Tuesday that the U.S. will get its first oil refinery in 50 years, funded by investments from Indian billionaire Mukesh Ambani's Reliance Industries. This is a historic $300 billion deal, the biggest in U.S. history, Trump said in a post on Truth Social. He thanked India's largest privately held energy company, Reliance Industries, for this tremendous investment. Reliance owns the world's largest oil refinery and Jamnagar, India, and has a market capitalization of $206 billion, according to LSEG data. The new refinery, located at the port of Brownsville in Texas, will strengthen our national security, boost American energy production, deliver billions of dollars in economic impact, and will be the cleanest refinery in the world, Trump said. The refinery is designed to process 100% American shale oil and is being developed by American First Refining. So, and then there's basically they have a 20-year deal on that. But yeah, I mean, I think this is fantastic. This is great. I love to see it. First new refinery in the U.S. in 50 years. That's crazy that it's been 50 years that has taken us that long. All right, let's take a look at interest rates here for just a second, because I did want to point out like what was happening with a lot of stuff. But let's look at commodities first. So obviously you can see here crude oil futures and Brent crude futures. So remember, there's two types of oil futures. You got crude oil and Brent crude. Crude oil is at $99.30. Brent crude oil is at $103.89. Now, what did I say last week? My prediction last week was that I said, yeah, oil is going to go up. It's going to go over $100 a barrel. I basically said, yeah, that's pretty much a foregone conclusion. Earlier this week, I mean, let's go back to the 5-day here for a second. Brent crude. You can see here it kind of spiked up on Monday over 100, but then it had quickly come back down. But then it would kind of bounced up and down over 100 all week before ending up at about $103. Crude for the 5 days basically massively spiked up to about $115 here on Monday, and then came all the way back down to about $80 or so, and then drifted all the way back up to about $98. So kind of a wild week with oil. I mean, as the Wall Street trading firms basically just hanging on every word of what was going on. Is the Iran war conflict? Is it going good? Is it going bad? Are people getting through the strait? Are they not getting through the strait? So obviously any just little news is massively moving this. Now, just a couple of things I'd like to point out. First of all, the United States gets very, very, very little oil. Only about 2% of our oil actually comes from over there in the Middle East. So you might be asking yourself, well, if that's the case, then why is our oil here spiking? Well, I think part of this is Wall Street. Part of this is Wall Street traders see a chance to make a buck, and they're driving up the cost of Brent crude. That's just kind of par for the course. It's what they're going to do. So I think some of this is a little bit of stock market manipulation. Some of this is genuine market concern. Some of this is just the news and what are we getting, and that's causing some fluctuation. So it is a number of things going on here. But like I said, I said last week I thought it would go up to $100, and I think that this might even go up a little further. We might even see this get up to $110. $115 a barrel, something like that. I just wouldn't be shocked one bit to see it get up to that range here in probably in the short term over the next couple of weeks, I would say. So okay, and then what were stocks doing? Well, the stocks were down for basically the third week in a row. The Dow Jones Industrial Average, after hitting an all-time high of 50,000, has pulling back down to 46,558. I'm actually happy about that. I actually think that's a great thing, man. Buy the dip, baby. Buy the dip. NASDAQ Composite dropped back down to 22,105, and the S&P 500 dropped back to 6632. So again, nothing to panic about. I think if we have some good news, or if hopefully if this Iran conflict thing, if this can wrap up somehow magically in the next month or two, I think stocks will bounce right back. So not the end of the world. Now this is a little bit more. Let's look at interest rates here for a minute. So interest rates, bigger issue. 30-year bond, you can see here, 30-year bond, he's basically spiking up to 4.9%. That's, not the best thing in the world. The 10-year note is now up at 4.282%, going in the wrong direction here. 7-year note crossed over 4%. The 5-year note is now up to 3.860%, basically threatening to go up to 4% itself. 3-year note now all these, the 3-year, the 2-year, the 1-year, all getting into the mid threes here, 3.6, 3.7. So again, heading the wrong way here. But the bond market, undoubtedly, they see risk, and that's gonna drive up rates. I mean, it's absolutely going to drive up the rates. So, but the 10-year Treasury, obviously being the most important, the one that we keep the most watchful eye on, going up here to 4.282, not the direction that I wanted it to be in. I really wanted to keep that thing more around 4%. So obviously not a good herald here for interest rates. And let's see what effect did this have on mortgage? What effect did this have on mortgage rates this week? Well, in a normal world, geopolitical unrest and economic uncertainty would push bond yields lower as traders moved into safe haven investments. That would cause mortgage rates to fall. However, the specter of possible renewed inflation as oil prices soar in reaction to the Middle East conflict has actually pushed yields higher. According to the Zillow Lender Marketplace, the current 30-year fixed rate is now back over 6% at 6.08%, up 10 basis points from last weekend. The 15-year fixed rate is up 12 basis points to 5.62%. And we can see here now, these are mortgage rates as of today, March 14th. 30-year fixed, again, is at the 6.08%. 20-year fixed is at 6.06. The 15-year is at 5.62, and the 5/1 ARM is at 6.05. Now, if you were going to go to refinance rates a little bit higher. 30-year fixed on a refinance is at 6.24. The 15-year fixed is at 5.79%, and the 5/1 ARM is at 6.02%. Now, interest rates certainly going up here, but nothing to panic about at the moment. I mean, it did go back over 6%, but not massively back over 6%. So again, I think that we've all kind of just got to hope here that this Iran conflict does not go on for another 6, 7, 8 months. We hopefully something can happen here that could kind of wrap this thing up in the next month or two, and then hopefully we could see some of this stuff kind of go back to normal. But until then, as long as there's this massive uncertainty, and heaven forbid if things get worse, heaven forbid things get worse, the government and the military start talking about troops on the ground and troops going into Iran. I mean, obviously that's a major escalation and a bad thing. So I think you could again you could see things really go sideways for a little bit. You could see things get really wonky out there. That is a possibility. That is absolutely a possibility with where we're at. So I will say this. I mean, you cannot rule out the economic damage that could come from this. In other words, if things really escalate and things get bad, say the price of oil spikes up to $120, $130 a barrel, gas prices here go up. You see basically this increased inflation. That's not good, man. I mean, that is just not going to be good to the overall economy here in the U.S. I mean, things were just starting to kind of take shape from all of the kind of economic plans that Trump had coming rolling out of the gate, and I think you'd be crazy not to say that a lot of that stuff is in jeopardy. I'm not ready to hit the panic button yet. But I think you got to be realistic though, and you got to say that some of this stuff is really in jeopardy here. So, but that all being said, with the Iranian conflict, everything else like that, I have a much, much bigger concern than even that. And my concern is something that I have been talking about for many months now, and it's called private credit. And now let's take a look at this. So this was really interesting. I got this from a post on X, and this was great because it basically shows you these are all the headlines just within the last, couple of weeks here. Well, if you go back to February 3rd, the last month, but most of these are within the last week and a half here. So let's just go through. I'm not going to read every single one of these, but let's just go through and take a few of these. So first one. Private credit stocks crash after shock report reveals huge exposure to collapsing software sector. SaaS apocalypse strikes as private credit software stock vicious cycle accelerates. The canary in the coal mine just froze. Here is what is really happening at Blue Owl. Private credit rocked by UBS shock outlook, record cascading defaults, and widespread contagion. Here we go again. Billions vaporized in spectacular private credit collapse. HeartNet, private credit trigger for market flush now in play. All hell breaks loose in private credit. Private credit panic goes to 11 as world's largest private credit fund hit with record redemptions. BlackRock slashes private loan value from 100 to 0. Let me say that again. BlackRock slashes private loan value from 100 to 0. And that happened within a quarter. A quarter. They went from saying this, oh yeah, this is valued at 100 cents on the dollar. It's 0. I mean, wow. Private credit fire sale begins. World's largest asset manager Gates investors in $26 billion fund. Insurance companies crushed as private credit contagion spills over. Fund described as first domino in private credit bank run, hit with over 7% in redemptions. JP Morgan limits lending to private credit groups after marking down loan collateral. Now that last article right there came out on Wednesday, and that was basically the talk of Wall Street this week was JP Morgan basically limiting their private credit group after marking down loan collateral. I can't even express to you how big that was. That is big, big, big news. And it basically takes this whole thing to another level. When you have the biggest, baddest bank in the world basically saying, yeah, we're going to stop lending to private credit groups. And not only that, we need to go in and check the collateral on the loans that we have and maybe start marking some of these things down because they see losses coming. Okay. There's only one reason to do that. They see losses coming. Okay. It's just so everybody understands that. So, okay, let's go to some of these private credit articles I have here. So, why bank stocks are getting beaten up over private credit. Well, some investors are cashing out of private credit funds, and that could leave banks more exposed to them. So many private credit funds have been barring the door for their clients. They had better hope their bankers don't turn off the taps too. Funds that make loans to companies are also themselves borrowers, often from banks. In good times, funds like non-traded business development companies use borrowing to boost their returns. Now, I got to pause for a second and say this. So, what they're actually talking about here is what's called lending to NDFIs, non-depository financial institutions. And what they do is they either lend money or they sell loans to these NDFIs. And now, NDFIs, it's a little bit of a smorgasbord. Like it could be a bunch of it could be a hedge fund, that could be a private equity firm. That could be somebody like Rocket Mortgage. Rocket Mortgage could have Rocket Mortgage is a mortgage company. And Rocket Mortgage has to have a way to actually make mortgages to the customers they're dealing with. So what they do is they'll go to, say, JP Morgan, and they'll get a massive, what's called a warehouse line of credit. Now, the warehouse line of credit, that's what they use. So every time they make a mortgage, they fund it with the warehouse line of credit. After they make the mortgage, within 30 days, they package because they use Fannie Mae and Freddie Mac underwriting guidelines. and they then sell that loan into the secondary market within 30 days of closing. And then once that loan is sold in the secondary market, and then they get paid back, and then they take money and they pay back their line of credit, less the profit they made, and then they go out and basically just do the thing again. And that's how that works for any company, any mortgage company that is a non-bank. That's how they do it. Now, so then the question becomes, okay, we gave this, I don't know, say $100 million line of credit, maybe the $10 billion line of credit to Rocket Mortgage so they can make all these mortgages. What really is our collateral on that? Yeah, okay, it's technically it's the mortgages that were made to these individuals, but those mortgages are also moving in and out very quickly. Like they're coming in, they're getting sold, they're going out. So there can be a little bit of question there sometimes as to what do you actually have. And again, I'm just trying to give I'm trying to give everyone a flavor for what this is, what type of lenders, like what are we talking about, right? So you can have two different things going on there. You can have the bank selling loans to, say, a private equity firm, right? And that could be known as what's called an SRT, strategic risk transfer. I've talked a lot about that. I've done episodes on that. One of the episodes that I put out this week was, if I can look at it real quick, where is it now? Why am I missing that? I guess it was it must have been last week. Let me go back here for just a second here. Okay, yes, it was last week. So last week I did a review of the FDIC report on bank lending to non-depository financial institutions, NDFI. So if anybody has not had a chance to go look at that episode, go look at that episode. That FDIC report is incredible, explaining the NDFI market and how big it is and how it's grown and all the people involved in it and why there's such a big concentration amongst the largest lenders in the country. So if you want more information on that, definitely go to those reports. Because again, I've spent a lot of time talking about the private credit market and breaking down the different facets of the market and how it works. So again, I know that was kind of way off topic, but I just want to try to give people some context here so they can understand what is being talked about in some of these articles that I'm running through here. So, okay, now back to this article here for a minute. So, when times are tough, they can borrow even more, in part to ensure they have enough cash to redeem investors who want out. That can be a better option than having to sell loans, possibly at fire sale prices. Now, obviously, we just saw with Blue Owl, they just sold 1.4 billion in loans because of redemptions that they were getting, partially because of redemptions they were getting hit with. But stressed markets are also when banks might need to reevaluate the commitments they have made to those funds. If they don't, the banks will ultimately have to answer to their own investors. Banks are already under pressure. The concern is likely to intensify in coming months, especially as investors ask how much banks stand to lose if a lot of private loans drop in value. And the answer to that is a lot, a lot. The KBW NASDAQ index is down nearly 10% so far this year versus a 2.5% drop for the S&P 500. Deutsche Bank fell around 7% Thursday after saying it had a roughly $30 billion loan portfolio exposure to private credit. Calming investors without hurting growth isn't easy for banks, though, and it could become tougher if the war in the Middle East results in oil shocks. Again, so, okay, yeah, we'll put that aside. We'll put the oil shock thing aside for a second, right? So I just want people to understand this private credit market is about a $1.8 trillion market. $30 billion to Deutsche Bank, that's nothing. That's nothing, okay? I think that some of the bigger banks here, Goldman Sachs, Morgan Stanley, Wells Fargo, Bank of America, Citibank, JP Morgan, they are going to be on the hook for hundreds of billions of dollars. And lending to the NDFIs has been the number one growth lending area for all of the big banks over particularly the last 6 years. So you're talking about taking away their number one growth engine on lending, and it is not an insignificant piece of their loan portfolios. Like it is sizable enough. It could cause them some major problems. So, okay, but let's continue on here. Why Blackstone and BlackRock can ride out the private credit storm. As investors pull back from private credit, having diverse businesses is key. There may be little that Blackstone or BlackRock can do to stop the runaway train of negativity about private credit, yet investors should keep in mind that private credit is hardly their only business. Last week, the two giant fund managers both reported that they faced jumps in first quarter redemption requests from their flagship non-traded private credit funds, which cater to wealthy individual investors. What got less attention, however, was that Blackstone's flagship non-traded real estate fund recently had its best month for investor flows in years. That points to the potential for the biggest and most diverse managers to have other strategies on the upswing, even while credit struggles. The two firms dealt with recent exit requests in different ways. Blackstone Private Credit Fund, or BCRED, went the route of allowing almost 8% of the funds to be redeemed above the initial 5% cap on redemptions. BlackRock's HPS Corporate Lending Fund, or HLend, stuck to its 5% limit. Now, it's also very important for people to know, and they do not point this out in this article, Blackstone put $400 million of its own money into covering those redemptions. And they did that because they did not want people to panic. The problem is these redemptions are not going to stop. They're going to continue. And at a certain point, Blackstone will be forced to cut off the redemptions. And when that happens, why do you think BlackRock cut off the redemptions? You don't think that BlackRock could have thrown in their own money and easily covered, if they got, 5 or if they got 10 or 12 or 15% redemptions? You don't think they could have done that? No, of course they could have done it. They did it because they know what's coming next, and they basically want to set the stage right up front that, like, no, we're not going to allow people to take their money out. If we mark everything down to zero and you lose all your money, tough cookies. You're going to lose all your money. Now, it also shows you a lot about the size of these firms. Now, obviously, BlackRock is just a massive, multi-trillion dollar, enterprise that, they can absorb quite a lot. Blackstone, on the other hand, not so much. And this gets back to the point of why they put $400 million of their own money into covering the redemptions, because they really, in a certain respect, they have to, because they could sustain something, but they can't sustain what BlackRock can sustain. Now, also with Blackstone, could this turn into some kind of like a quasi, Lehman Brothers type moment, Bear Stearns type moment? I don't know. I mean, we're certainly not there yet, but it does make you a little nervous. It does make you a little nervous. That is absolutely the case. This article here is, again, I kind of laugh at some of these things, and I have a lot of respect. The author of this article is Telis Demos. And Telis has been around for a long time. I have a lot of respect for the guy. The guy has been a great journalist for the Wall Street Journal for a very long time. He's done a lot of great work over the years. But this article here, this is the friendly this is Blackstone and BlackRock calling the Journal and calling Telis and basically saying, yo, dude, we need some positive press here. Can you, we're getting a lot of hit pieces right now. Can you throw us a bone and throw a positive spin on this whole thing out there for us? So there's definitely some bias in this article here, and you could see it plain as day. But like I said, we'll hold off on that one. We'll put that aside for the moment. All right, let's look at this one. I think people find much more interesting. So, an exodus of money endangers Wall Street's private credit craze. Investors asked to cash out 14% of Cliffwater's $33 billion fund, while Morgan Stanley caps withdrawals. So, and you can see here index stock performance the past 6 months. S&P 500 financials are down about 10%. But look at Apollo. Apollo's down 27%. KKR down 42%. Blackstone is down 44%. And notice how I said here, could this be with Blackstone? Could this be another, Lehman moment, Bear Stearns? Well, their stock's down 44%. That's nothing to sneeze at. If it was down 20%, you could make the argument of like, oh, well, that's like bear territory. 40% plus, you're getting into some nasty waters at that point. Ares Management down 46%. Blue Owl Capital is now down over 53%. Blue Owl, they're in trouble. I'm just going to say it right now. I think Blue Owl's in serious trouble. I'll show you another article here in a minute because they got sued by Western Alliance for 126 million, as I reported on last week, but then they responded to that. But we'll get to that in a second. But the private credit engine that powered massive growth on Wall Street is sputtering, with investors trying to pull money out of big funds, forcing firms into uncomfortable decisions and endangering their future profits. The latest example came Wednesday when Cliffwater told clients that investors in its largest fund asked to cash out 14% of their money this quarter. The $33 billion fund will pay out about 50% of the redemption request, meaning that the other half will need to wait at least another quarter to exit, or maybe not at all. Cliffwater sold its funds primarily to individual investors, a playbook that larger competitors like Apollo, BlackRock, Blackstone, and Blue Owl adopted, making them all increasingly dependent on retail money for growth. They harbored hopes of getting an even bigger slice of individuals' money, pushing to get access to 401ks. Thank you, Lord, that did not happen. I talked about that when that was being proposed, and I was like, this is a bad idea, because I saw the potential for this very situation on the horizon. And one of the things we're going to talk about in a second when we get through, I only got another article or two here on private credit, but we're going to get to an article here at the end of this discussion here on private credit, and that is the vibes. Like, what does this feel like? This feels to me a lot like 07, 08. And we're going to get to that in a second. Like, why do I feel that way? Well, I'll paint that picture for you guys in just a few minutes. It's not the same thing. It's very different. 07, the real estate market, ultra low rates, just different dynamics, different things going on. But it's the underlying, the modus operandi, if you will, of Wall Street. That's what concerns me. It's the modus operandi. It's the way that they go about doing certain things. They're always looking to pass the buck while collecting the fee in the process. And so like I said, it's the vibe. It's that vibe that is like. But we'll talk about that in just a second. So, but like I said, thank goodness that this really hasn't gotten into 401ks. But these retail investors, and again, when they say retail investors, who are they talking about? They're talking about ultra high net worth individuals that most likely qualify as what is known in the eyes of the SEC as accredited investors. These are people that are worth probably a minimum of 20, have a net worth of probably 25 million bucks and larger. So these are very wealthy. This is not like your meme stock crowd on Robinhood, buying this stuff and getting access to this stuff. No, these are the primo, uber, ultra wealthy individuals that saw a chance to make more money through what would be considered an alternative investment. So, but anyway, okay, we're getting back to it. So the strategy started backfiring unexpectedly in recent months. Some bad loans from both private lenders and banks raised questions about other potential losses. As a herd mentality spread, investors raced to get out of the door. At the same time, the investment firm's stocks are tumbling, with Blue Owl now off more than 40%. Banks, including JP Morgan Chase, are reassessing the risk of their own exposure to the industry. Though the firms can limit how much gets out each quarter, meaning dramatic collapses are unlikely, the flight of money could stay elevated in coming quarters, analysts said. They point to a similar slow bleed from the real estate funds in 2022 that built up over months and took years to recover from. Retail capital is going to be a lot more cautious. An individual investor in private funds and an author of a newsletter about the industry stated, in the short term, there is not going to be one financial advisor allocating money to them. Executives in the private credit world say there is an overreaction to a few bad investments and that their industry is healthy. The bulk of the corporate loans the funds invested in are performing well, unlike the commercial mortgages and real estate funds, which sank in value when interest rates jumped 4 years ago. Now, I think that's total. I think that's total hogwash. That is absolutely not what's going on. You got BlackRock writing down the value of collateral and funds from 100 cents on the dollar to zero. You've got JP Morgan massively now really seriously looking into, okay, we need to mark down collateral on some of these private credit loans. So to sit there and say like, oh, it's just a couple of bad loans, it's a couple of one-offs, it's nothing, no big deal, nothing to see, nothing going on here. It's like, yeah, no. And again, and I do think that these funds could get into such trouble because again, it could be a domino effect. Like in other words, if there's enough money, if there's enough redemptions demanding, like we want our money back. So in other words, they could in theory cap it at 5% every quarter. But what could happen is they could basically be forced to liquidate these loans because the redemptions could get so massive, and the pressure from investors to get the money back could become so massive that they might have to just throw in the towel and basically start selling loans, and basically and then the fire sale starts, and then you see loans getting sold for 60 cents on the dollar, 50 cents on the dollar, 40 cents on the dollar. And then it just becomes, okay, we sold all the loans, we're closing the fund down, we're going to give back to investors whatever we got, and that's that, and again, you could start to see that type of thing happening, or that type of scenario beginning to unfold here. So but let's look at this. Okay, so now these are a couple attached articles, if you will. So, how a British mortgage company became private credit's latest black eye. So, private asset-backed lenders fueled the rapid rise of a London firm that went bust last month. So, this was another. So, last year in the third quarter, we had Tricolor Holdings. We had First Brands, we had Prima Lend, and then there was probably about like 7 or 8 smaller companies that went bust, and now we get this London mortgage company, kind of like I said when I was using the Rocket Mortgage, kind of a much smaller version of Rocket Mortgage, but basically something along those lines. So once again, some of Wall Street's most sophisticated players missed the warning signs when Market Financial Solutions, known as MFS, went to raise money from private credit funds in 2021. It was a little known British mortgage company specializing in short-term loans for quick property purchases. The firm's fundraising materials provided sparse details on its chief executive, Paresh Raja, and offered financial information that diverged widely from its public financial reporting, according to documents reviewed by the Wall Street Journal. That fundraising effort wasn't successful, but Market Financial Solutions found plenty of other banks and private credit firms eager to lend it money. Wall Street was hungry to make asset-based loans a booming sector in recent years, and MFS seemed to fit the bill. Lenders, including Apollo Management, Atlas SP Partners, Barclays, Castle Lake, Jefferies Financial Group, and Banco Santander backed Market Financial Solutions over the years. The company said its mortgage lending business had tripled in size since 2022 to more than $2.4 billion, or more than $3 billion last year. Now MFS is collapsed and facing accusations that it pledged collateral more than once. Its founders are in Dubai, where they reside some of the time, and the lenders want to know what happened to their money. A spokeswoman for Raja declined to comment. The administrators now in charge of the entities that are in insolvency are laying off most of the staff and said they would look to investigate the circumstances behind the collapse. Before the current court proceedings, Raja had said MFS temporarily couldn't access its bank accounts. MFS had said it had maintained a cautious asset-focused lending approach. Private credit investing soared to more than $2 trillion in recent years. Fund managers raised money from clients and lent it out, paying the investors dividends from the interest collected. The industry has taken business from big banks and is pushing to loosen federal regulations so that private credit can be included in 401k savings accounts. Market Financial Solutions is the latest worrying blowup. Last year, car parts supplier First Brands and auto lender Tricolor entered bankruptcy court amid allegations they both tricked lenders by using collateral multiple times. So this is a theme. This is a theme now we are starting to see with the this is why JP Morgan was going in to write down collateral, because I think this is going to be endemic of a lot of problems. I think there's a lot of fraud here in the private credit market. I think a lot of these people said, "Hey, man, I've got all these private credit lenders and bank. This is a huge market. They're all willing. They're all throwing money at me. I could take it. Hey, okay, I'll tell them all. Oh yeah, sure. You could take a lien on this collateral. You could take a lien on that collateral. Sure, yeah. But it's a what do you call it? It's just a sleight of hand. I mean, they're just pledging the same collateral for multiple loans, and that's why BlackRock had to write the loan value from 100 cents on the dollar to zero, because again, stuff like this is what is happening. Okay, where was I at here? So first bankruptcy amid allegations. So HPS Investment Partners, a private credit fund that BlackRock bought for $12 billion last year, was stung by a telecom services company that went bankrupt. Private credit chieftains, including Apollo CRE Mark Rowan and Blackstone President John Gray, said last year that these were isolated cases and that fears of wider stresses in private credit are overblown. Most private asset-backed debt is performing as expected, but the growing drumbeat of failed deals has led to redemptions by individual investors, punishing the stocks of fund managers, and private funds have taken some significant write-downs on pieces of their portfolios. Now, then it gets into like rapid growth, but I want to get down to the bottom here. Let's see here. Okay, so in late 2025, some of the lenders had become concerned about their loans and the information flow from Market Financial Solutions, according to people familiar with the matter. When they sought additional information, it didn't arrive, the people said. Barclays stopped processing some MFS-related transactions and froze the accounts it handled, the people said. Apollo's Atlas moved to push Amber bridging and Zircon Bridging into insolvency and applied in court for administrators to take over at MFS2. The matter was urgent, the court was told, because Amber and Zircon appeared to be missing $930 million in collateral. An Atlas spokesperson said its total exposure is around $400 million. A Castle Lake spokesperson said it still has around $70 million invested after selling some of the debt. Santander is owed more than $200 million, a person familiar with the matter said. Some lenders to MFS exited before it collapsed. Centerbridge Partners, a private credit fund, found the company unresponsive to information requests in late 2024, according to people familiar with the matter. The New York-based fund asked for its money back and got it well before MFS fell into insolvency. So again, very interesting stuff here, happening. I mean, again, and again, when you see the pattern of this stuff, I mean, this is the same type of garbage that was going on with Tricolor Holdings and with First Brands. Okay, here, Jefferies executives respond to Western Alliance suit. So the bank CEO and president rebuffed statements they called absurd and false and misleading, adding that Jefferies has no obligation to repay $126 million. So Jefferies CEO Rich Handler and President Brian Friedman on Monday accused Western Alliance CEO Ken Vecchione of making false and misleading statements with regard to the lawsuit the Phoenix, Arizona-based bank filed against Jefferies on Friday. Western Alliance on Friday claimed Jefferies breached its contract and committed fraud when it said it would not repay $126.4 million connected to bankrupt auto parts supplier First Brands. Both the lawsuit and Mr. Vecchione's statements ignore the simple reality that Western Alliance did not extend credit to Jefferies. Handler and Friedman wrote to clients and shareholders on Monday. Rather, Western Alliance began lending money in 2021 to Leucadia Asset Management Trade Finance Group, an entity affiliated with Jefferies but owned by the Point Bonita Master Fund, whose business is to purchase First Brands receivables, the Jefferies executive wrote. The loan agreement at issue in the lawsuit is between Western Alliance and a second Leucadia entity, a special purpose vehicle that holds First Brands receivables, the executive wrote. That agreement expressly precludes Western Alliance from seeking recovery from special purpose vehicles, shareholders, managers, or affiliates obligated entities, Handler and Friedman wrote. Jefferies honors all its obligations, the executive wrote. Jefferies has no obligation to pay off a non-recourse loan Western Alliance chose to make to a special purpose vehicle against First Brand's receivables. Handler and Friedman noted that Western Alliance asked to have the Point Bonita Master Fund and Jefferies guarantee the loan shortly before First Brands filed for bankruptcy in September. Those requests were denied. Yeah, that's called too little too late. Western Alliance nonetheless began a forbearance with the Leucadia entities with no guarantees from Jefferies, Handler and Friedman wrote. So they do have a point here. I think Jefferies does have a point here. The way that it appears that this whole thing was structured. I mean, yeah, they don't have any guarantees. This was money that they had lent to this special purpose entity, not to Jefferies directly. So it'll be interesting to see what happens here. But probably Jefferies probably walks away from this at the end of the day. Western Alliance this might get thrown out. We'll have to see. It'll be interesting to see what a court ultimately decides in this case. Okay, so what private and credit investors need to know about the industry's turmoil. Here's the lowdown on advisor fees, fund returns, and what is driving client redemption on Wall Street. So financial advisors around the country have been fielding calls from clients worried about their private credit holdings. A surge of requests by investors to pull money out of private credit funds has prompted a number of Wall Street firms to limit withdrawals, marking one of the first big tests for an asset class that has grown rapidly in recent years among the wealthy. The turmoil comes after signs of distress. I'll skip ahead of that. So now it gets down to, this is kind of interesting. So it says, I invested in a private credit fund at my financial advisor's recommendations. What did I buy? Good question. If you invested via an advisor, chances are you are in a private fund that makes loans to riskier companies, most of which are private equity backed that pay higher yields. The funds are typically open to accredited investors. What did I say earlier? Very wealthy individuals are seen and defined in the eyes of the SEC as accredited investors, individuals with $1 million or more in investable assets. The most popular type of private credit fund is a non-traded business development company, or what's known as a BDC. These let investors cash out once a quarter and generally cap these redemptions at 5% of shares. The funds typically charge a management fee of 1.25% a year of the value of your investment. You will also pay a performance fee of 12.5% on net investment income. Another category of private credit funds, interval funds, works in a similar way, but unlike non-traded BDCs, interval funds are obligated to offer to buy back at least 5% of shares a quarter. They can also contain a wider variety of loans that non-traded BDCs. There are also publicly traded BDCs that can be bought and sold like stocks. Now it says, how have these funds performed? Not so great lately. Why are people selling? Well, we've talked a lot about that. How concerned should I be about stress in the industry? Well, you should be very concerned. Yes, very concerned. Does my advisor have an incentive to keep me invested in private credit? Wonderful question. That depends on how your advisor gets paid. Most independent advisors are fee only, meaning they charge you an annual fee based on a percentage of the overall assets you invest with them. The percentage can vary depending on the amount you invest. Other advisors, including many at firms such as Morgan Stanley, UBS, and Merrill, are paid on commission and get what is known as a trailing fee. These are ongoing annual fees ultimately paid by the investor as long as the investment is held on top of the fees the fund charges. In the case of most non-traded BDCs, that fee is 0.85%. Advisors would lose out on that if you redeem your shares, but could theoretically earn another fee if you chose to reinvest the money into a mutual fund. So there you go. So hopefully some good information out there. Maybe if some wealthy people happen to be listening to my wonderful podcast, that's not funny. It's just not funny. That's not funny. It's a serious business here. Serious business here. Yes, hopefully that's good information for you out there. So if you're disgustingly rich and you've invested in these funds, here's what you should be thinking about. Call your advisor immediately and hope it's not the Wolf of Wall Street. So, all right. All right, why a Wall Street insider warns the markets feel ominously like they did in 2008. And this is what I was talking about a few minutes ago, the vibes of this whole thing. So, financial conditions, including rising oil prices and mounting pressure in private credit markets, are increasingly resembling the lead up to the 2008 financial crisis, according to Bank of America strategist Michael Hartnett. Investors fear that higher oil prices could mire the U.S. economy in stagflation, forcing difficult decisions at the Federal Reserve, right as private credit stress threatens to destabilize the financial system. Investors are increasingly worried that despite talk of unprecedented times, we have been here before and the first go didn't turn out so well. Case in point, a take from Bank of America raising parallels between recent action in oil prices and concerns about the health of the financial system and the Great Recession of nearly 2 decades ago. Asset performance in 2026 was more ominously close to the price action seen from mid '07 to mid '08, wrote the bank strategist Michael Hartnett in a recent note to clients obtained by Bloomberg. He highlights that oil prices doubled between July of 2007 and August of 2008, right as the effects of subprime mortgage defaults ripped through the financial system, ultimately leading to the Great Recession. Today, investors are worried that a similar pattern is playing out. They fear a sustained spike in oil prices stemming from the war in Iran will aggravate inflation and slow economic growth, while stress in private credit markets spills over into the banking system. Private credit is the elder concern. Two bankruptcies last year raised questions. Of course, in recent weeks, a stampede of investors racing for the exits has forced private credit funds to restrict redemptions, setting off alarm bells for some market watchers. But okay, so I wanted to point this out. So he's talking about kind of market setups, right? Market setups, whatever. And the issues in Iran are to be worried about. Absolutely, are to be worried about what they could do. But like I said, that is not my primary worry. The private credit market, that is my primary worry. Right. This second, that's my primary worry. I think that there should be some. I think Scott Bessent, and maybe he is behind the scenes. I don't know. I think Scott Bessent should be calling all the big banks in. I cut one of the articles I covered. In the episode that I did on the when I covered the FDIC report on bank lending to non-depository financial institutions, NDFIs, one of the things I did at the end of that episode was I covered an article from S&P Global that showed the top 20 NDFI lenders, and you could see it was all the biggest banks in the country. I hope Scott Bessent's on the phone with those top 20 banks and basically saying, yo, guys, we need to get together. We need to have a Zoom call and we need to talk about private credit because I need to know right now if there's going to be a major problem here. And so again, hopefully that's going on. But I think this article also misses the mark in the sense of what I would call the vibe. So in other words, let's go back to '07 and '08 for just a minute, if we shall. How was the system working back then? Well, okay, so uh, Wall Street would lend, like a big bank would lend the mortgage loans, and then they would sell them, and they would sell them in various ways. They would package them into mortgage-backed securities, and then they would do different tranches, and then they would sell those mortgage-backed securities, and then those would get sold again, and it just like went down the line. And as it went down the line, everybody was looking to pass the buck. They were looking to pass that risk to somebody else until the risk eventually got to what? Back to the retail investor through some fund or whatever. And that whole thing blew up. And it was like, okay, well, who owns this thing at the end of the day, and who a lot of times they weren't sure. They couldn't tell you. Well, I don't know who owns it. Yeah, some investors, whoever bought the fund is just sitting in their 401k, whatever. Who knows? And all along that production line, if you will, all along the production line, everybody's just taking their fee out, taking their fee. Everybody gets their fee. Everybody's passing. It starts at the very beginning with the realtors who would make the loans, take their commission, off it went, on to the next person. And then it went to the Wall Street, and it went to the bank, and then it went to Wall Street, and then it went all, and it came full circle all the way back around. But in the process, everybody's taking their fee, right? Everybody's taking their bite of the apple. Everybody's taking their fee, and then when it all blows up, it goes sideways. Like the pigs at the trough. All of a sudden, everybody's like, "Oh, hey, I don't, yeah, you can't blame me. I didn't. What did I do? I didn't do anything, right?" Um, that's what this feels like with the private credit. Like, in other words, the big banks start lending to these companies, the private equity, the hedge funds. They start selling their loans to these companies. Then these companies, the private equity and the hedge funds, they start lending to other people, and then those people are taking the money, and then what do? They're like, okay, oh, they recognize that, like, oh, we might have this giant steaming turd over here, and we've got to do something with this. Oh, hey, let's get this. I know what we can do. Let's get this in the hand of private investors. Let's put this into people's 401ks. Let's put this, like, I saw this coming. I saw this coming. And I looked at, because I've seen the movie before. I've seen this movie before, and I know Wall Street. Like, I know their pattern of behavior. I know what they do. They operate off of fear and greed. This is it. It's fear and greed. Those are the two main things driving Wall Street. They want to find a way to make a buck at anything. And if they can lay the risk off on the consumer or the retail investor, they are happy to do it, and they will do it every time. And so, like I said, when I saw all of a sudden, it's like, oh, we got to get the private credit into the hands of these 401ks. We got to get individual investors investing in all these funds because it's so wonderful. We're making so much money, and we just want to share the love. It's like, no, they don't really want to share the love. They want to share the risk, and then they want their fee at the same time that they're sharing the risk with you or laying off the risk entirely on you. That's the name of the game, and that's what they want to do. And that's what I mean by the vibes. The vibes of this thing feel like we're back in 06 and 07 again, but right before things, just the proverbial blank hit the proverbial fan, if you will. So I'm just saying, like, that's what this feels like. So yeah, so a little bit of concern there. So all right, so that is kind of my talk on private credit. I want to switch gears now over to the Fed here for a minute. So we had this big ruling just, I think this was just yesterday. Yeah, this was just yesterday. So court blocks subpoenas tied to criminal probe of Fed Chairman Jeremy Powell. The court ruling comes as Powell's term winds down. A federal judge blocked subpoenas issued to the Federal Reserve as part of a criminal investigation of Chair Jeremy Powell. In a March 13th ruling, Judge James Borsberg found that the subpoenas were intended to harass and pressure the central bank chief into lowering interest rates or to drive him from office so a more compliant successor could be installed. Did prosecutors issue those subpoenas for a proper purpose? The court finds that they did not, Borsberg said in a ruling. On the other side of the scale, the government has offered no evidence whatsoever that Powell committed any crime other than displeasing the president. Powell said in January that the Department of Justice had served the Fed with grand jury subpoenas related to his June 2025 testimony about renovations to the central bank's headquarters. The Federal Reserve declined to comment. Approved in 2017 and budgeted at $1.9 billion, the overhaul was later revised to $2.5 billion. I would point out that everyone that the Buffalo Bills just completed a brand new state-of-the-art stadium in Buffalo, New York, and that only cost them $2.1 billion. So this is literally $400 million over and above what it cost the Bills to just build a brand new state-of-the-art football stadium. So just keep that in mind. And these are some small buildings in DC. These aren't a giant football stadium. So the increase reflects higher labor and material costs, the discovery of asbestos and soil contamination, and extended construction deadlines, and of course, Jeremy Powell's private VIP suite office and the rooftop decks, the lounges, the private five-star restaurants, the massage lounges, and the day spas, and all the other crazy amenities that they wanted to put into the buildings here. They left that part out, though. But Powell expressed doubt that the criminal investigation was driven by his testimony before the Senate Banking Committee or by the cost overruns, calling them pretext. Instead, the Fed chair asserted the probe was part of an intimidation campaign by the administration to ease monetary policy. This unprecedented action should be seen in the broader context of the administration's threats and ongoing pressure, Powell said in a January 11th video statement. The threat of a criminal charges is a consequence of the Federal Reserve setting interest rates based on our best assessment of what will serve the public rather than following the preferences of the president. Now, Jeanine Pirro, U.S. Attorney for the District of Columbia, says the Boasberg decision has neutered the grand jury's ability to investigate crime. As a result, Jeremy Powell today is now bathed in immunity, preventing my office from investigating the Federal Reserve. This is wrong, and it is without legal authority, Pirro said in a March 13th news conference. Days after Powell announced the investigation, Pirro stated that he could have avoided a formal investigation if the institution had just responded to our outreach. Pirro, in a January 13th statement on X, noted that the U.S. Attorney's Office had submitted inquiries regarding the costs behind the renovations and Powell's remarks before lawmakers last summer. The word indictment has come out of Jeremy Powell's mouth and no one else's, said Pirro. None of this would have happened if they had just responded to our outreach. This office makes decisions based on merits, nothing more and nothing less. President Donald Trump denies involvement in the investigation. I don't know what he is, but he certainly doesn't do a very good job, the president stated. For the past year, Trump has repeatedly lambasted Powell and his colleagues at the central bank for not lowering interest rates fast enough. So, I don't think there's there's not a whole lot left in this. So I have a couple of mixed feelings here. First of all, is I think that you can make the argument that this was somewhat politically based, right? That they're basically going after Powell because they wanted to either get him to lower rates or get him out. So I think there is an argument for that. However, U.S. District Justice Pirro, Judge Jeanine, as I know her, as probably everybody knows her, she went to a grand jury. She got, now I know the whole, you could get a grand jury to indict a ham sandwich. I know all that, whatever. I'm just talking about procedure. She followed proper procedure. She took her evidence. She went to a grand jury. Those grand juries issued subpoenas. They issued the subpoenas to the Fed, and the Fed, Jeremy Powell and other people, the Fed just completely ignored them. And we're just like, yeah, whatever. And then they went out and got this judge, this federal court, James Mosberg. They get him to basically come in and say, yeah, there's nothing here. There's no evidence. Who is he to deter? This is a grand jury that basically went out. This is unheard of. And the only reason I'm pointing this out is this is unheard of. When does this federal judge, step in to basically tell grand juries that, like, no, you can't issue subpoenas and you presented no evidence and you could, like, it's just I feel like this is a massive overreach from this judge, from this Boasberg, massive overreach here on his part. And this is also going to lend credence again to the crowd out there that basically hates the Fed, can't stand the Fed. It basically says, the Fed is completely and totally above the law. This feeds into their argument that, again, the Fed is beyond reproach. You can't go after them. You can't question anything they do. They are infallible in the eyes of everyone in the government. That they can't be held to a higher standard, that they can't do anything wrong. This feeds into that argument big time. Doesn't help it. And I think, Judge Jeanine, she raised a very legitimate question. Like, why couldn't have they just responded? If they just responded, none of this would have happened. This wouldn't have been necessary. Maybe they respond with some answers and they're like, okay, all right, they responded. They're, whatever. That seems legit. It's fine. Okay, we'll move on. So again, it just there. I have, like I said, I have mixed feelings on this one because I think that you can see this from multiple angles, and this has really become a mess. And because first of all, like I said, I think it is insane. I'll say this right up front. I think it is insane that the Federal Reserve is spending $2.5 billion of our tax dollars. Okay. And keep in mind the hypocrisy here. And this is what makes me mad. Keep in mind the hypocrisy here. You go to tell the Federal Reserve, hey, Federal Reserve, we want you to do X, Y, and Z. Nah, go pound sand. We do what we do. You don't tell us what to do. We're independent. We're independent. You can't question our independence. But then they screw up and they mess the whole economy up. And you're like, well, you guys aren't doing such a hot job of running the economy. Actually, you've done a horrible job throughout the entire course of your entire history of your organization. So, yeah, maybe you shouldn't be so independent. Maybe you should have to answer. Maybe we should get some audits of what's going on over there. And then they immediately clutch their pearls. They're like, oh no, you can't question our independence. That you can't do that. And they immediately they take out the shield of independence. They throw that in front of themselves. And then the media runs like obedient lackeys out there to protect them. How dare you? You can't question their independence. We don't care if they set the whole country on fire. Yeah, they're independent. You can't question that. But then at the same time, you can't question them. You can't audit them. They do whatever they want. But when it comes time for them to build their new headquarters, they will take your $2.5 billion of tax money and they will build themselves the Fed Taj Mahal, the Fed Mahal over there. They will build their in the lap of opulence. And no problem. They will take your tax dollars, and I'm like, you know what? If the Fed is so independent, they could pay for that themselves. Okay. They could cut their own check. You could take that out of Jeremy Powell's bonus. All right. That's how I feel about it. I'm sorry. I don't care. That's how I feel about it. Like, it is nonsense that they would take that money from U.S. taxpayers to build their Taj Mahal over there, and then have the audacity to question anybody when somebody comes back and says, we'd really like an audit of the Fed. We'd like to know what you guys are doing over there. And then they're the pearl clutching. No, how dare you? How dare you? You can't question us. So, again, I think I think a lot of this is just it's absurd on the part of what's going on. And I do think the Fed has a lot to answer for. I think they got a lot to answer for. And, sorry, it is what it is. For any of the people that will lay down at the altar of the Fed and defend them to the death, sorry, they got a lot to answer for. All right, now Fed meeting next week. The Fed will almost certainly hold the Fed will almost certainly hold, meaning interest rates, at its meeting next week. Here's what's still up in the air. So the Federal Reserve is widely expected to keep its key interest rate in a range of 3.5% to 3.75% at the conclusion of its two-day meeting on Wednesday. Policymakers will release their quarterly economic projections, revealing how they expect inflation, economic growth, and other economic metrics to play out in the wake of the Iran war. The Fed is caught between the need to keep rates higher for longer to stamp out inflation and lowering them to encourage spending and help the job market. The Federal Reserve policymakers are nearly certain to keep their key interest rate unchanged when they decide on monetary policy next week, with the real question being how officials are thinking about the Iran war and its effects on inflation. Again, not really looking for the Fed to make a move here. I agree with this. I really don't think that they're going to make a move. I don't think that they are going to do anything as far as cutting interest rates. I think they're just going to hold pat. And as we're going to see here in a few minutes when I get to it, when we talk about the inflation numbers and the GDP, the jobs numbers, again, I don't think there's enough there at the moment to warrant them cutting rates at this second. I think they certainly had a window that they should have lowered rates more already. I've discussed that at nauseum at length over the last 6, 7, 8 months. But now that window, I think, is a little bit closed at the moment. And we do have to wait to see how some of these economic indicators, how things pan out, how things shake out for the week. But we will keep an eye on that. Now, so like I said, this week coming up at the Fed meeting, expecting them to stand pat and not reduce interest rates. Okay, now I have an article here on the upcoming potential change to the Basel III Endgame capital rules, but we'll come back to that in a minute. First thing I want to do, this is the time in the program where usually I shift gears. I like to give everybody some banking news. I like to give everybody the economic indicators for this week coming up. And I like to talk about the episodes that I put out this week. And I did have 6 episodes come out this week. So, but first, as you can see here on the screen, I want to go into the economic indicators for this week. So on Monday, March 16th, we got the New York Empire State Manufacturing Index. We get industrial production. On Tuesday, March 17th, we get the ADP Employment Change Weekly, the pending home sales, the 20-year bond auction, API Weekly Crude Oil Stock. On Wednesday, March 18th, we get the core PPI, the regular PPI, factory orders, interest rate projections at 2 p.m., the FOMC statement at 2 p.m., Fed interest rate decision at 2 p.m., and then the FOMC press conference following at 2:30. On Thursday, March 19th, we get building permits, initial jobless claims, continuing jobless claims, Philadelphia Fed Manufacturing Index, the Philly Fed employment for March, new home sales, Atlanta Fed GDP now for the first quarter. And on Friday, March 20th, we get the U.S. Baker Hughes oil rig count. So a lot of economic news coming out on Tuesday and Thursday. And then obviously the big Fed decision with their meeting minutes and their press conference coming on Wednesday. So we'll definitely keep an eye out for all that. So, okay, let's go to some banking news real quick, shall we? Some other economic indicators. So housing starts up. Building permits are down in January. Existing home sales increase in February. So existing home sales increased by 1.7% in February, but were down 1.4% from a year ago. Small business optimism dips in February. Consumer credit was up in January. Retail sales also dipped in January. Business inventories were up in December. Treasury and the IRS propose rules for the Trump accounts. So the Treasury Department and IRS announced proposed regulations to provide guidance on a pilot program for Trump accounts, a new type of individual retirement account for children. So I'm sure there will be more news coming out on that here in the coming week. Consumer prices up in February. Mortgage applications did increase the following week. FDIC's Hill says basically Camel's proposals is coming soon. So FDIC Chairman Travis Hill said that over the past few months, the federal banking agencies have made significant progress on reforms to the Camel's rating system that they hope to propose in the coming weeks. So that will be, I'll tell you what, that will be a great opportunity. I've been, doing the podcast for probably about 2.5 years now. I have always wanted to do an episode on camels. I'm kind of actually shocked that I haven't gotten to that yet at this point. But I'll tell you what, when those changes come out, that will be the perfect time for me to get into camels, the camels rating, talk about what that is. So every bank in the country has a camels rating, but the camels rating is kept private. That camels rating is issued by the regulators, and it stays completely private between the bank and the regulators, and that's it. The only people, it's not unless the bank fails or there has other issues that Camel's rating could come out. And a lot of times that really comes out around like management issues. If there's some kind of major downgrade the M in Camels is for management. So if you have some kind of major management issues, maybe there was a shakeup at the top, or the CEO got fired, or somebody retired, and the new person came in and just messed everything up. It could be a myriad of reasons, right? But that's usually when you hear about the Camel's rating. So, but other than that, like I said, it stays private, stays between the regulators and the banks. But that Camel's rating system is a lot of great stuff in there, a lot of really good stuff in there. So, like I said, I'll cover that when the time is right. So, okay, but continuing on here. Senate passes housing bill as ICBA continues push for regulatory relief provisions. I'm going to talk about that bill here in just a few minutes when we get back to the articles. But the Senate passed housing legislation without ICBA advocated community bank regulatory relief provisions, though ICBA continues working to advance these policies as the debate continues. So the Senate passed the 21st Century Road to Housing Act by a bipartisan vote of 89 to 10. The measure may proceed to a conference committee to reconcile differences between the House and Senate versions. So yes, so like I said, more to come on that momentarily. ICBA and others request extension of comment period for the Genius Act proposal. So ICBA and other groups requested that the OCC extend the deadline for public comments on its proposed rule on implementing Genius Act provisions on issuing payment stablecoins. In a joint letter to the OCC, ICBA and other groups said the OCC should extend the comment period by 60 days. The existing 60-day comment period is insufficient to effectively examine and comment on 367 pages of material. Yeah, I did get the proposed. So what happened here is that the OCC put out the proposed Genius Act rule that came out last week. It is 376 pages. I think I talked about that a little bit last week, but I've got the rule. I've been reviewing it, but it's massive. It is a lot going on in there, and I agree with them. I don't think 60 days is enough time to review that beast. The proposed rule could have serious and significant implications for financial institutions and the financial system more broadly. Banking groups need additional time to properly analyze the NPR and provide useful input. So yes, I do agree with them here, and I think they should extend the period, give them probably another, give them another 60 days on top of the 60 days I already got. And I think that would probably be a good thing. Now, here's another thing I just want to read to everybody. And this came out on March 11th. And I just want to read this. So, because this is not what I was expecting. Stable coins will not get any kind of deposit insurance under the U.S. Federal Deposit Insurance Corp's proposed rule under the Genius Act, as reported by CoinDesk, citing FDIC Chair Travis Hill in his remarks at an American Bankers Association summit in Washington on March 11th. So according to Travis Hill, the chairman of the FDIC, he basically said in comments that the stablecoins will not get any deposit insurance coverage at all. Like that is very very surprising to me. For a product that they are trying to legitimize, and they are trying to get the mass market to adopt the use of stablecoins. They're not going to offer any FDIC insurance on it. Which again, that is very interesting to me. I could kind of see it from an accounting perspective and how the stablecoin is treated. Like, is it a liability of the bank? Is it not? If it is a liability, can you offset it with an asset like with the lending? I don't know. Like I said, I still have a lot of questions on that. But again, I was very surprised to hear those remarks. But like I said, we'll see what happens with this. But I like I said, I think they should extend the period, and we'll see what happens. But obviously, this kind of log jam that we're in, so to speak, on the crypto legislation continues. Guidance on AI agent systems must reflect the realities of community banking. ICBA recommended to the National Institute of Standards and Technology that any future guidance on artificial intelligence agents reflect the realities of community banking. Yes, I would agree with that. ICBA state groups urge senators to add community bank provisions to the Housing Act. We just kind of talked about that a minute ago. So they wanted more stuff to be added to that housing bill. ICBA commends administration's cybersecurity actions. So ICBA commended the Trump administration for releasing President Donald Trump's cyber strategy and for America and executive order on combating cybercrime, fraud, and predatory schemes. Yes, I have an article talking about that we'll get to in just a few minutes. And then Trump administration takes executive action against cybercrime. Like I said, yep, got that as well. We'll be covering that in just a few minutes. Okay, now let's get to what episodes that I have come out this week. All right, so last Sunday, I put out a BND strategy room bonus episode. Basically, is the private credit market about to melt down? Now, this episode was simply a clip taken from last week's live stream. I've been doing this more recently, where I've taken clips out of the live stream on specific topics, and basically putting them into episodes, because there is a lot of people out there that basically either don't have the time or don't like to listen to 2 hour, 2.5 hour live streams. And so I try to kind of package some of these topics that I think are really good and really important, and put these into what I'm calling bonus episodes. But that's what I did last Sunday. I basically did a bonus episode there on private credit, and basically did a whole bunch of the private credit coverage and put that out there. So that was the bonus episode for Sunday. And then starting on Monday through Friday, I had all new episodes. So Monday, I had Remembering American Economist Dr. Murray Rothbard. So Dr. Murray Rothbard would have turned 100 years old on March 2nd, 2026. Dr. Rothbard was an American economist of the Austrian school, an economic historian, political theorist, and an activist. Dr. Rothbard was one of the most prominent economic thinkers of the 20th century. He was a central figure in the libertarian movement. Politically, he was right-leaning, but got involved with both political parties throughout his career. He was founder and leading theoretician on anarcho-capitalism. He wrote extensively, publishing over 20 books, thousands of essays, and was editor of various periodicals and journals. Dr. Rothbard is absolutely one of the economists from the 20th century whose work should be studied. And so, again, I find Dr. Rothbard to be a very, very interesting individual. I was first introduced to him when he wrote his very famous book called The Case Against the Fed. And that was a very, very good book. And he brought up a lot of very interesting issues in that book. I find him to be a fascinating individual, because I think in today's world, people just they just, everybody wants to label somebody something. Oh, they're Democrat, they're Republican, they're conservative, they're liberal, they're this, they're that, they're the other thing. Everybody wants to pigeonhole everybody, so to speak, as something, right? And I think he was very fascinating individual, because he was all over the place, man. He was like, I'm with the Austrian school, I'm a libertarian, I'm a conservative right wing guy, and then years later he's like, civil rights, and I'm with the Democrats, and I'm more progressive now. And then it's like, okay, now I'm back to libertarian. I want to be this anarcho capitalist. So he was all over the place. And again, it's not about agreeing with everything somebody says. You're never going to agree with everything anybody says, maybe except for me. But that's a joke. That's a joke. It's a joke. So, and again, it's not about agreeing with everything somebody says, but the guy, there's no doubt whatever things you either liked or didn't like. I think there's plenty to like and plenty not to like. But the guy was just an amazing thinker. He was a highly intelligent, brilliant economist that thought very deeply about a lot of economic issues. And he wrote a massive amount of literature. And he is absolutely a guy that is to be remembered, that is to be studied, because I think a lot of the stuff that he did was very thought-provoking. Even if you didn't agree with it, it was thought-provoking, and he brought some very good things to the forefront. So, like I said, just wanted to mention that Dr. Murray Rothbard. I thought that was a good episode. So if you're interested in maybe learning a little bit more about him, it gets a little bit more in depth in the episode. You go check that out. Okay, the rest of the week, the next 4 episodes, I was basically covering reports. I've covered a lot. Last 2 weeks, I had a lot of reports to cover, and I wanted to get a lot of this stuff out. So I covered a lot of this, but all really good, really, really good stuff. So on Tuesday, I did a review of Cornerstone Advisors report, What's Going On in Banking 2026. So Cornerstone Advisors released their annual report of what's going on in banking for 2026. The report focuses on banks and credit unions in the United States and provides survey results from hundreds of bankers. The main themes in this year's reports were AI, crypto, tech spending, fraud, and payment channels. Most bankers are very optimistic about the overall outlook for 2026. Deposit gathering continues to be their main focus. They view big fintechs as their main threat. AI adoption is increasing. Fraud continues to be a big problem. Most believe tech spending will increase. Most banks are talking about tokenized deposits, blockchain, and stablecoins. Instant payment adoption is increasing, but not where it should be. Most banks are focusing on CRE and C&I lending in 2026. Banks should be doing more with fintech partnerships. And then finally, what is going on with open banking? So again, great report from the good people over there at Cornerstone Advisors. They always do such amazing work. Then on Wednesday, I did review of the FSB, which is the Financial Stability Board. I did the FSB report, vulnerabilities in government bond-backed repo markets. Now, obviously, I have talked very extensively about the repo market here in the U.S. This was a phenomenal report. So this report was released in February, and it basically outlines 3 vulnerabilities in government bond-backed repo markets. The interlinked potential sources of structural vulnerabilities, which include, number 1, repo markets can facilitate a buildup of leverage. Number 2, demand and supply imbalances in repo markets can arise quickly in stress periods. And 3, repo markets are highly concentrated along various dimensions. This report is excellent, providing background on repo markets, how they work, structural vulnerabilities, interlinkages, and potential contagion. Repo markets play a critical role in facilitating the flow of cash and securities throughout the financial system. So yes, I believe it is critical, absolutely critical. If you want to understand the inner workings, the plumbing, if you will, of the market and how it works, you've got to understand repo markets, and you've got to understand what is at the center of repo markets. You've also got to understand how repo markets can go haywire and what are some of the potential vulnerabilities out there right now. I don't believe it was an accident that the FSB decided to put this particular report out there at this particular moment. I have covered what have I showed you guys repeatedly in the repo markets. I've showed you how all the liquidity has been drained out of the repo market by the Fed's reduction of their balance sheet, and why we've been having these spikes in liquidity. We've been having these massive liquidity spikes over the last 4 or 5 months in the repo market. So I've talked extensively about that. So as I said, because of that, and because I have warned about potential problems in the repo market, I believe that is why this report magically appeared at this moment. But it is a phenomenal report. If you want to learn more about repo markets, absolutely go check that report out. Go watch that episode. Okay, and then final 2 episodes were on Thursday. I did what is the CFPB really costing American consumers? Now, this I thought was a very interesting episode because we looked at 3 reports that had recently been released. One was from the U.S. Government Accountability Office, or the GAO. The second one was the U.S. Senate Committee on Banking, Housing, and Urban Affairs. And the third one was from the White House Council of Economic Advisors. Now, these reports had dueling narratives about what the impact and cost of the CFPB has been on the American consumer. The report from the GAO has multiple charts outlining actions and events that have occurred at the CFPB over the last year. That report is a rather short report, but it does a really good job of just laying out just all the key events, key things that have happened, when they happened, looking from different perspectives on like employee layoff, actions of the agency, legal actions that were going on, political, back and forth. So they did a good job of adding a lot of really good charts in that article there, or their research report rather. The Senate report tries to make the case that the CFPB has returned upwards of $30+ billion to consumer. The problem is the analysis is extremely flawed, and that is putting it kindly. That is putting it very kindly. That report from the Senate, I would regard as hot garbage. They basically, I mean, when you see how they got the information of their research, it's a joke. It's really bad. I think they should be ashamed of themselves. They even put that piece of garbage out there. But I digress. So now the White House report effectively shows how much regulations and oversight from the CFPB have cost consumers and driven up the cost of obtaining financing. The costs go well above $200 billion and could be as high as 300 and I think $67 billion. The report also highlights what I think is the biggest issue, and that is the massive concerns around over politicization of the CFPB in recent years. And then, so, so at the end of the day, what is the real cost and impact of the CFPB? I thought that the White House Council of Economic Advisors, I thought their report was excellent because it shows you the economic impact of all the regulation put out by the CFPB and how that they have driven up the cost of getting loans, getting every kind of loan. They've driven up the cost of getting a residential mortgage by $1,700. They have driven up the cost of an auto loan. They've driven up the cost of credit cards, of student loans. That impact on the economy, on the consumer, it's there. I mean, you can see it. I mean, the numbers are there. And again, and I think, but putting the numbers aside, it's the politicization of the CFPB that has always been the biggest concern that I've had. I make no bones about it. I don't like the CFPB. I don't care for it. I didn't like it when it was created. I hate it even more now. And I've always believed that politics were at the heart of the CFPB, not this idea that they were going to be there to we're here to save the consumer. Like, no, it's always been about politics. And that's always been one of my biggest gripes with the CFPB. But anyway, like I said, I thought that was an interesting episode. I thought it would be somewhat of a controversial episode, but you know what? There were 3 reports. I covered the 3 reports. I gave my opinion on those reports, and I think the opinion was pretty spot on. So, you may go look at the reports and judge for yourself. So, okay, then finally on Friday, I did an episode. I reviewed the FDIC OIG report. Now, the OIG is the Office of the Inspector General report on Pulaski Savings Bank failure. So now, anytime a bank fails, the Office of the Inspector General inside the FDIC has to do a report on that bank failure. They got to come back and basically do an autopsy, if you will, and basically tell you, okay, why did this bank fail? What went wrong with it? What happened here? And so they came out with their report, and this report was crazy, to say the least. So Pulaski Savings Bank failed in January of 2025. The FDIC Office of Inspector General completed an in-depth review of the bank's failure, which was completed in March of 2026. Initially, when the bank was closed by the FDIC, they stated that fraud was suspected. The newly released OIG report blamed the failure on key employees and $20 million in liabilities not listed in the bank's financials, which caused the bank to be undercapitalized. Now, here's the problem with that. The individual serving as the CEO was also serving as the CFO, the CCO, and the chief cook and bottle washer. He was basically doing almost everything at the bank. The CEO was responsible for, wait till you hear this, financials, call reports, working with customers, dealing with investors. Like, I mean, the guy was maybe girl, I don't know, was just doing everything. Now, why is this a problem? This is a problem because the OIG states the responsibilities and activities of the CEO were far and beyond outside the normal scope of responsibilities of any typical CEO. They stated the CEO was critical to day-to-day operations that had major influence within the bank. Yet they failed to name the CEO as a dominant individual. So whenever you have an individual that has a massive influence like this over a particular bank or financial institution, you have to label them as a dominant individual in the report. And yet they did not do this. Why? So at the end of the day here, we are left with many, many questions at the end of this report. Why did the CEO apparently the CEO had a leave of absence in 2023. How long? We have no idea. They didn't tell us. How long was this absence? Who were these other mysterious key individuals? The bank had a 7-year history of MOUs. It's called as a memorandum of understanding, and MRBAs. Why were they not shut down sooner? Why was 20 plus million in liabilities not included in the bank's core system or financials? The failure caused a loss to the FDIC fund of approximately $28 million. This sounds like fraud to me. So why was nobody charged here? So again, I think this report was what I was. I'll put it to you this way: I was not expecting this. I was not expecting this at all. I was expecting them to be like, yeah, we initially thought it was some fraud. We looked at some stuff, but then it turned out not so much, and it was just maybe it was just massive incompetence, or the CEO who was doing everything under the sun dropped the ball on a couple places, and it just unraveled. Whatever. As I went through this report and was just going each page, and it was just getting crazier and crazier. I'm like, I don't understand this. What was this leave of absence? Why was this guy doing everything? Why wasn't he named as a dominant player? He had massive influence going on there. Who were these key employees? Why was $20+ million not included in the bank's system or included in the bank's financials? Those liabilities also ultimately led to the bank being undercapitalized, which led to the bank's failure. I mean, this absolutely sounds like fraud to me. So what gives? Like what gives? Like I said, it's just left with a lot of questions on this one at the end of the day. And so there haven't been a ton of bank failures in the last 4 years, like 24, 25. There was two bank failures in 24, two bank failures in 25. We've had one bank failure so far in January of this year. But so it's been a small number of bank failures, but the ones that have failed, man, there's been some very interesting fraud, different, the First Bank of Lindsay. There have been some very fascinating bank failure cases here. And while these banks have not been very big, even Pulaski Savings Bank here, I think was only about a $46 million asset bank. So it's very tiny. But even so, I mean, just kind of wild things happening at some of these banks. Now, one of the other banks in 2025 that failed was a small bank in Texas, and they again, when the FDIC originally closed that bank, they had suspected fraud there as well. And then that report from the OIG should be coming out here in the next couple of months, and I can't wait to see what comes of that. I mean, that might be another crazy case. So, but anyway, all right, those were my episodes that I had put out for the week. So let's get back to some articles here. I'm going to I'm going to actually run through some of this stuff rather quickly. So I can get us done, hopefully on time here tonight. So eased endgame capital rules will slightly lower bank requirements. So banks will see a small reduction in capital requirements as part of a proposed overhaul of capital rules set for release during the week of March 16th, with slightly larger reductions for small institutions, according to the Federal Reserve Vice Chair for Supervision, Michelle Mickey Bowman. The proposals developed jointly by the Fed, the OCC, and the FDIC are designed to finalize changes to international capital standards undertaken after the 2008 financial crisis. The changes include updating requirements for additional capital cushions at the largest and most complex banks, known as global systemically important banks, or the GSIBs. Bauman gave a preview of the upcoming changes during a speech and question and answer session on March 12th. The proposals would create a single standardized approach to capital requirements for large banks, including introducing new risk weightings for assets that impact smaller banks. Smaller institutions will also be able to opt into a separate simplified framework, the Community Bank Leverage Ratio, also known as the CBLR. Currently, large banks are subject to a dual standardized and advanced approach. Bowman said the Basel III endgame element of the proposal would result in a small increase in requirements for the largest banks, though it would mean a reduction in requirements overall when combined with the GSIB proposal. So again, a very interesting developments here on this. I will continue to follow this one and let everybody know what ultimately I find out. Okay, so U.S. Growth nearly stalls as the fourth quarter GDP revised to 0.7%. So the 43-day government shutdown weighed heavily on fourth quarter economic growth. So we saw the first estimate that we got was 1.4% from the Bureau of Labor Analysis. This is substantially down from the 4.4% growth that was registered in the third quarter, but also went to show how much of an impact the government shutdown really had on our economy. And we just saw this economic growth just really small for the fourth quarter of last year. Now, hopefully, that number has bounced back in the fourth quarter of this year. But that being said, again, not super great there, because we also have, as I reported at the very beginning, this other kind of limited government shutdown going on. But you got to believe that's going to have some kind of an impact as well. So we'll keep an eye on that. Is inflation cooling or stubbornly high? Both can be true. So as energy prices rise, the inflation picture is muddied by an unusual divergence between two key gauges of consumer costs. Now, what this article points out here is that we have three main inflation gauges. We have the CPI, the PPI, and the PCE. Now, the CPI is the Consumer Production Index. The PPI is the producers. Okay, so that's more companies. Okay, and then PCE is kind of a combination of the two. So the PCE is the Fed's preferred inflation gauge, but we can see here that for inflation here, we got the PCE here, basically at 2.9%, and we got the CPI though a little bit lower here at 2.4%. And then you go down here. Now we go to the core numbers, and the core PCE is over 3% at 3.1, and the core CPI is at 2.5. So again, what's at odds here is that the PCE is reaccelerating a little bit, yet the CPI is actually coming down a little bit. You could kind of see this in the chart there. If I could blow this up just maybe a little bit more here, you could kind of see here how the core PCE is going up, whereas the core CPI is going down a little bit. So again, this adds. The reason why I point this out is because it's kind of a little weird. I mean, you can see from the chart here that usually these things kind of move in tandem together, not 100% completely, but 95% of the time they're kind of moving together. So it's just unusual to see them cross. We saw it here back in 2021. We saw them kind of cross a little bit, but then later in the year they kind of came back together again and have kind of moved the same. So again, it's not unheard of for this to happen, but it is kind of a little unusual for this to be happening at the moment. So some of the inflation for consumers seems to be coming down, but the PCE seems to be trending upwards, which is again, and this is just going to add yet another wrinkle to what the Federal Reserve is trying to do when they're trying to make their decision and trying to determine if okay, can we lower interest rates or not. So and then we did get I don't see where I put that, but the CPI again was up a little bit this week. It did come in just a tad higher than expected. So like I said, so that's again kind of where we're at with inflation. We are seeing this, this slight pickup in inflation over the last couple of months, and obviously the oil situation in Iran not going to help that at the moment. So. But what's happening on the labor front here? A little bit more labor data as U.S. job openings unexpectedly rebound from a 5-year low in January. Fewer workers quit their jobs to start 2026, a sign of waning confidence about the labor market. So the number of job openings in January exceeded expectations, signaling potential renewed demand for labor amid sluggish employment conditions. Job vacancies climbed to 6.94 million from an upwardly revised 6.55 million in December, the Bureau of Labor Statistics said in its delayed report on March 13th. This is a sizable rebound from the more than 5-year low recorded at the end of last year. January's gains also topped market estimates, which pointed to a reading of 6.7 million. The jump in vacancies was broad-based, led by financial activities, 169,000, trade, transportation and utilities, 155,000, and private education and health services, 123,000. Job openings in manufacturing sector also increased by 69,000. This could be the start of thawing out of the labor market. So hopefully that would be the case, but we will continue to keep an eye on that. U.S. trade deficit shrinks 25%, driven by gold exports. So the monthly deficit has swung wildly as businesses adjust to tariffs, making any trend hard to read. So, but the U.S. trade deficit January 26th came in at 54.5 billion. And you can see here from the last few months, I mean, things last year were really trending in the right direction. We kind of saw this high in July of about 74 billion, but then it came down nicely. In August, it was 56 billion. In September, it was down to 49. And then in October, it really dropped to 31 billion. It was things were heading in the right direction. And then it really reversed. In November, it jumped back up to 56 billion. And then in December, it jumped back up to 72.9 billion, now coming back down to 54 billion in January. So the question is, will we continue to see that number come back down? Will it begin to kind of stabilize at maybe around the 50 billion mark? We'll have to keep an eye on that and see what happens. This was interesting this week. So the Agriculture Secretary says solutions are coming for U.S. farmers over escalating fertilizer costs. The costs have been rising due to the war in Iran. Agriculture Secretary Brooke Rollins said on March 13th that President Donald Trump and administration officials are looking at how to help farmers avoid fertilizer amid escalating costs due to the war in Iran. The president is very aware of these challenges and these issues. We are very close to having an announcement on some solutions on what that looks like. Rollins told reporters at the White House of Washington, we're looking at every potential avenue to keep the fertilizer costs down as these farmers are going into planting season. No big announcements yet, but it is coming. So we will keep an eye on that. So, okay, we got more moving here as again, as we have these kind of billionaire taxes floating around. I've reported on this before. So, ExxonMobil plans to move its legal home to Texas from New Jersey. CEO Darren Woods said in an interview the company is looking to protect itself from shareholder abuse. Very interesting. So Exxon's going to basically bolting that in New Jersey. They're going to move down to Texas. Then we got this, the push for 875,000 people to help get California billionaire tax on the ballot. The new wealth tax faces hurdles, including worries about driving off the biggest taxpayers. Now, that wouldn't happen, right? Right? That wouldn't happen, right? Right now, it wouldn't happen, right? Former Starbucks CEO Howard Schultz leaves Washington State, moves to Florida. Schultz Family Foundation will still be located in Seattle for the moment. Former Starbucks CEO Howard Schultz has revealed that he and his wife Sherry have moved their private family office to Miami as they enter what they portray as their retirement years. Sure. The announcement coincides with Washington state lawmakers advancing a millionaire tax proposal. Schultz's net worth was estimated at $3.5 billion as of 2026 by Forbes. Schultz recalled 44 years ago as they took a cross-country trip that led them to Seattle, where he began working for the company. But again, this is the trend that we're seeing. We just saw Mark Zuckerberg, a bunch of other CEOs just moved to Florida. They just bolted out of California as, again, they talk about trying to get this billionaires tax on here. And, this is the problem. I mean, again, and I'm not saying, because again, I don't have all the answers on this. I'm just saying that everything has repercussions, right? Like, in other words, if you tax the billionaires, and I'm not saying that they shouldn't be taxed. I think that we are entering an era where, like, again, I mean, Elon might become the world's first trillionaire here. I don't think anybody of any government, whatever, I don't think anybody in the history of the world ever thought that you would see somebody worth $1 trillion. I don't think that was on anybody's bingo card. And I do think that, and I did an episode not too long ago on the rise of this new category, the super billionaire. And that was basically any billionaire that had over $50 billion. And there's a bunch of them now that have over 50 billion. Again, I mean, it's almost like, you see these billionaires like Schultz has got 3.5 billion. That's like a pittance compared to like Michael Bloomberg, who's got like $130 billion, Warren Buffett, Bill Gates. Like, you go straight down the list. I mean, these guys have well over, some of these guys have well over $100 billion now. So yeah, I think there does need to be a conversation about, like, at what point have you made so much money? Have you accumulated so much wealth that you have unbelievable influence in business and politics, and because you can just buy companies, you just buy things up left and right and do this and do that. I think there does need to be a conversation at some point. And I would tell the billionaires should welcome that conversation, because being the student of history that I am, I could tell you that when things get really out of whack, you go back to days of yore, when you had kings and queens all over the place. When the king got too much and got too greedy and wasn't willing to share with the peasants, you know what happened? There was usually an uprising, and the peasants usually showed up and basically took everything they deposed the king and took everything they had. Because basically, hey, if you're starving to death and you're getting kicked off your land, you got nothing. Hey, man, you got nothing left to fight for. It's like, hey, let's go, baby. And so the history of the world tells us that things get too out of whack, usually bad things happen. And so I would just say that, like, yeah, there needs to be some kind of conversation around this, right? But like I said, I don't have the answers. I don't know this, but what I want to point out to people is that, like, when you have to understand the consequences, though. When you put these billionaire taxes on here, this is what's going to happen. They're going to just leave. They're going to move to another state where they don't have to pay those taxes. They're going to move their companies. Those jobs are going to go with those companies. These people have very large businesses that employ a lot of people and pay a lot of taxes to the state. And these states could go into like a death spiral, going around all this, this stuff. They increase the taxes, the business leaves, the tax rolls go down. They don't have the money to pay for infrastructure and all the ridiculous amount of welfare and all the other stuff they want to pay for. And this is where it goes. It just circles the drain at some point. So I point this out because this is a trend. This is a major trend, and it's gonna get worse. It is going to get worse. Absolutely. Okay, and I did have a bunch of other stuff, guys, but I do have to wrap up here at 10 o'clock tonight. So so this housing affordability basically got cleared in the Senate as an investor ban creates headaches. Yeah, maybe it does, maybe it doesn't. But the bill would target housing affordability by giving local governments incentives to make it easier for companies to build single-family homes. Ban on investors buying single-family homes is being pushed by President Trump, but home building groups and some lawmakers oppose the restriction. House Majority Leader Steve Scalise told lawmakers the bill will need to go through further negotiations and changes before the House passage. So originally, a lot of the Republicans were basically ignoring the ban on investors. So basically, they were just ignoring it. And we're like, yeah, we don't want that. We're not going to put that in there. And of course, they got a lot of pushback from the president, who was like, no, that's going to be in there. And it needs to be in there. I've been a big advocate for this. Blackstone and State Street and they should not be running around buying up all the houses, okay, to turn them into rental properties. This should not be happening. Period, end of story. This should not be happening. But the question is, does this bill really do that? And it really does not. So we got a couple articles here. So Congress's new plan to address housing affordability, more apartments. So this is what the Democrats want. The Democrats want more apartments, even though I think you could make a very real argument that we already have a glut of apartments in the U.S. right now. I think that argument can very well be made, that we already have a glut of, there's been an apartment building binge for the last 5 years that's been insane. So I think we might already have a somewhat overbuilding of apartments. This is not going to, building more apartments is not going to solve the problem. People want houses. They want to be able to afford a house, not to afford another apartment. Then we get this. The Senate's new housing bill would force large investors to sell homes. The latest provision would require these investors to dispose of newly built homes within 7 years. So this is not the outright ban that we wanted. This is kind of like a weird. So I'll just read. So in A bipartisan bid to make homeownership more affordable, the U.S. Senate is aiming to restrict the industry that builds homes to rent them. Senators recently inserted a new provision in the latest housing legislation that would require large single family home investors to sell their newly built rental properties to individuals within 7 years of completing them. Investors and builders were blindsided by the move and say it would effectively dismantle the single family rental business for large companies and real estate investment trusts and lead to higher housing costs. No, absolutely no. It would not do that. And keep in mind, this is only houses that they build. This has nothing to do, and this is my issue with it. This has nothing to do with all of the existing homes on the market that they've already bought up and continue to buy up existing houses. This is just like this is more like they go in, they want to build 300 houses, and then they'll rent them all out. This is basically saying that if they do that, they would have to sell the houses within 7 years. They obviously don't want to do that, but this doesn't. This is a minor thing. They obviously buy far more existing homes than what they're building, and this is what I have an issue with because this is not the housing ban. This is not a ban on them buying and owning rental, turning existing houses into rental properties. I want an outright ban, not this weird funky stuff over here. So like I said, so I have a lot of problems with this bill. I do not think that this bill delivers on what it's supposed to do. And again, I think that the Democrats are out on left field on this one, and the Republicans are not serious about what needs to be done because they're getting that BlackRock, State Street, Vanguard, cheddar cheese, and they don't want to do anything that's going to stop them from getting the donations, so to speak. So okay. I had some other things here, but I might just save this to next week. And that is SBA expands its ban on non-citizen lending. I had this to talk about small business, see big trade-offs with online lenders. I'll talk about that next week. Ghost jobs are clouding the hiring market. I've talked about that before. We'll talk about that a little bit. The battle over return to office mandates continues. Yeah, we'll talk about, and then the AI-fueled layoffs are rising, but a great divide is emerging. And this basically talks about how, yeah, the bigger companies are cutting, but the smaller businesses are still hiring, and they're still even though they may be using AI, they're still hiring and still looking to grow. And then just a couple more things. So Regions accelerates its plan to build 150 new branches. The bank originally gave itself a 7-year timeline for the strategy, focusing on Florida, Georgia, and Tennessee. Now it aims to speed that up, that plan by 2 years. Trump issues fraud order after bank execs push national strategy. The president's order comes a day after industry executives emphasized the need for better coordination among lenders, law enforcement, and government at a House subcommittee hearing. Upstart to apply for a national bank charter. The time is right to launch the first bank built from the ground up on AI. Wisconsin Credit Union to buy a local bank. The fifth tie-up this year between a credit union and a bank comes one day after a trade group launched a major campaign in opposition to such deals. Revolut gets full license approval from the UK. So this was just interesting. Millbury National Bank. I just wanted to mention this because Millbury National Bank, I believe, is the oldest bank in the country. It is over 200 years old. So it's it's a small bank, but an interesting story. Like I said, I'll probably talk about that a little bit more next week. Robinhood launches an offering via private market investing. And this was funny. I wanted to get to this. This was like corporate jargon that we hate. This is really funny. I might, I'll have to come back to this next week. But some really funny terms in here: bandwidth, change agent, circle back, decision tree, decisioning, deep dive, growth mindset. Some of our favorites. So I'll get to that next week because that's pretty funny. So, all right. Well, let me go to wrap up mode here real quick, and then we'll get to our story of the week, and we will get to our quote of the week. So okay, if you're listening on Apple Podcasts or Spotify, I really could use some reviews, so please be sure to leave me some positive views. Make sure to check out thebankernextdoor.com. A lot of great stuff on the website there. Make sure to subscribe on YouTube if you want the latest announcements and postings that I put out there. let's see here. Is that, yes, okay, I got the website up there. So send comments, questions, or topic recommendations to info at the banker next door at bankernextdoor.com. Make sure to follow me on social media at Getter, True Social, and X. BND is on YouTube, Rumble, and all major podcast platforms. We have new episodes that come out every Monday through Friday at 12 noon. BND Strategy Room is usually every Saturday night at 8 p.m. Right here on YouTube. And now let's get to our story of the week. So last week I did federal income tax. This week I'm continuing that theme. We're going to talk about self-employment tax. So self-employment tax is the imposed tax that a small business owner must pay to the federal government to fund Medicare and Social Security, similar to the FICA tax paid by an employer. Self-employment tax qualifies you to receive Social Security benefits and Medicare when you are old enough to qualify or you become disabled. Self-employment tax is due when an individual has net earnings of $400 or more in self-employment income over the course of the tax year, or $108.28 or more from a tax-exempt church. Self-employed people who make less than these thresholds from self-employment don't have to pay any tax. Self-employment tax is computed and reported on IRS Form 1040 Schedule SE. As a self-employed person, you owe both halves, the 12.4% Social Security tax on up to $137,700 of self-employed income for 2020. This is a couple years old. I apologize. You also owe an additional 2.9% for Medicare taxes, no income limit. One benefit: when you figure out your taxes, you can deduct half of your self-employment tax from your net income as a business expense. So they charge you the full thing, but then you can deduct half of it off of your net income as the business expense. So there you go, self-employment tax. So, okay, let's get to our quote of the week. So this comes to us from General George S. Patton. Good tactics can save even the worst strategy, but bad tactics will destroy even the best strategy. And yes, that is very true. Good tactics can pull you out of the fire, but bad tactics will destroy even the best strategy, will fall apart undoubtedly with that. And that was from George S. Patton, our quote of the week. So with that being said, wrap up. I say thank you so much for joining me tonight. I hope everyone has a great rest of the night, has a great weekend out there. New episodes will be back Monday through Friday. I got some really good interviews coming up this week that hopefully everyone will enjoy. But that being said, have a great night out there. Thank you for being with me in the strategy room. Until next week, be safe out there. I'll see everybody again real soon.